All right, friends, welcome back to another episode of Multifamily Deal Talk. I'm your host, Kevin Parrish. I have a very good friend in here, buddy, that I've known forever today. And he's brought actually a really good deal that's very timely for the marketplace, I would say. So let me introduce him, read his bio, and then we'll jump in. He joined Newmark in 2015 and currently serves as a managing director of multifamily capital markets. His focus of expertise is in the secondary markets throughout Texas and New Mexico. He has significant experience in the industry, including acquisitions, dispositions, asset management, and property management, as well as development and capital markets analysis. Previous experience at Trivest Residential for Henry S. Miller. Graduated with a Bachelor of Business Administration degree in finance from Southern Methodist University. Was a starter on the SMU men's soccer team, where he competed in the College Cup and was awarded ESPN, the magazine's Academic All-American. That's awesome. Didn't know that.
A long time ago.
After a short stint in the MLS, Major League Soccer, he began his career in commercial real estate. Since joining Newmark, he has seen transactions totaling over $10 billion in volume and has been a part of just over 400 deals. He is married and they have 4 children. I'd like to welcome Mr. Matt Wideman to the podcast. Matt, welcome.
Kevin, thanks for having me.
Absolutely,
excited to be here, man.
AKA Fat Matt. So
past life, man. Past life.
Well, as I said, dude, we go back quite a ways. We were just looking at a picture in my office probably 10 plus years ago. And that's like right when you and I first met.
Yeah, it's really funny. When we first met, Kevin, I think we were sitting on opposite sides of the table. Mm-hmm. You were a broker and I was on the acquisition side. So,
and now we flip-flop. There it is.
Grass is always greener, baby.
Yeah, 100%. Yeah, or where you water it, they say.
That's
maybe.
Right,
so, right. So
just don't stand on it too long.
Yeah, exactly. So, well, appreciate you being here again. The, theme here is talking deals. So I'm just going to ask you a quick opening question.
Sure.
And then we will jump into your deal.
Perfect.
And then we're going to do something fun at the end.
All right.
So cool. So first question, just general question. I ask every guest, why multifamily?
Multifamily, I love multifamily. I think multifamily is a really interesting dynamic within the commercial real estate marketplace. So when I first jumped into commercial real estate, I got to see all the different food groups, self-storage, hospitality, office, retail, industrial. I did my fair share of lease audits and fun times with that, and loved
I don't envy that.
All those things, but ultimately saw multifamily as number one, it's a core need in our marketplace. People have to have a place to live, and number two, it just was the most fun from what I saw, because you're dealing with people and you're dealing with where people live. So all that being said, I think multifamily has a lot of legs left. It's a core investment. Love it, and I think there's a long future ahead for it.
Well, if that doesn't excite you about multifamily, I don't know what does. So again, general question, just ask all our guests just to get their take.
Sure.
So you ready to talk about a deal?
Let's do it.
Let's do it. So as discussed, I've created a framework that I call the SAFE method to source, analyze, finance, and exit apartment community investments safely and profitably. So let's just take your deal. Let's run it through that framework, starting with the S of source, and fire away.
So I jumped in 2007, and one of the very first things I got to do when I jumped into the industry in 2007 was work on this very exciting scenario. So what happened was our friends over at Newmark, formerly known as ARA, called us up when we were at Trivest and said, hey, we've got a group who owns 52 assets, and they are in trouble.
Goodness.
They were a well-known syndicator at the time, probably not too different from a lot of the syndicators in the world today.
So were these all in Texas?
They were majority in Texas, although there was others outside of the state.
Okay.
But the ones we focused on were the 52 that we looked at were in the state of Texas.
Okay. So let me stop you just with the sourcing. Tell us about the total unit count, what the vintage was, and then the 3 types of deals we talk about are core, value add, opportunistic. What style were they?
Sure. So the problem that this syndicator had was he had so many fires going on at all the different properties. So he had just turnover in management, not enough money to fund turns on deals. The only way he was able to keep the whole thing going was to buy the next deal. And unfortunately, there's a lot of guys probably in that similar situation.
Sure.
Today.
So that's what I was going to ask was that a the reasoning he was in trouble, was it because of capital markets related issues from the great financial crisis? Was that the beginning of it?
It was right on the front end of it. So it was 2007 when all this went down. So it was really a precursor. He was probably one of the first ones before the GFC happened. But basically, he had built a machine, and his machine was built on buying deals. And he accumulated quite a bit of deals over the years.
Sounds like a lot of people that
we
both know today.
Yes. And he had done a great job on the acquisition side. The issue for him was the maintaining and asset managing, and dealing with each deal. And I think ultimately, when he grew that fast, there was just so many fires to put out that he couldn't handle all of them. So what we ended up doing was we met with him, found out the situation that was going on, found out who his major limited partners were in his deals. And then we sat down with them to say, let's analyze all 52 deals. Let's find out which ones actually have some equity left in them. And then let's create a plan, a structure whereby we can, we're going to have to adjust your basis in these deals. But if there's equity worth preserving, we're going to figure out a plan that will hopefully satisfy you guys and allow us to inject fresh capital into the deal and come with a plan.
This is awesome. I'm very excited about this. You're already telling me about it. So let's unpack this a little bit before we jump to the analysis piece. So sourced it. You guys had a relationship at Trivest with a broker here in North Texas. In Houston. Okay, great. So they knew that you guys had ownership, you were experienced, y'all had been doing it for a while, and you were on the short list of people to call for a portfolio of this size. That's right. So again, what was the average vintage?
Yeah, so I would say most of these deals were 90s or newer type vintage. There were some older ones.
So at the time, maybe 10, 15 years old. Probably A deals.
Less than that. Back in 2007. So these were 10, 15 years old.
So newer, I'd say core plus type properties.
Correct. Okay. In Austin, San Antonio, Houston, and Dallas.
So of the 52, what was the total unit count? Just average ballpark.
52. There were probably 30,000 type units.
Okay.
And ultimately, what we discovered through that process was there's probably 9 that were worth really focusing on. Really interesting. That had still had a good amount of equity left in them. The remainder of them were probably in a bigger, tougher situation.
Okay. Well, I would definitely like to hear what potentially happened on the other, 40 or so, but let's stick with the 9. Okay. So we're moving to the analysis now. That's how you guys sourced it. That's great. Now, from an analysis perspective, you were talking about meeting with him, limited partners. Walk us through that, and what made you guys think that these 9 were worth paying attention to?
Sure. So the 9 assets were in Austin, Houston, Dallas, and San Antonio. They were all Texas, all 2000 plus vintage. Okay. And back then, the basis in these deals, I think so back up, all of these had CMBS loans on them. Okay. And so all of these were in trouble and had already started the default process with the special servicer on the CMBS line. So when we stepped into that situation, what we were doing was we were not just looking at, is there a lot of equity left in these, but where do we think we have negotiation power in a situation where we can actually engage with the special servicer and create a plan that might be able to go to the court with the bankruptcy court and execute on that plan. Sure. So first we had to get buy-in from the general partner.
So just one step back, on the CMBS loans, they're mortgage-backed securities, right? So were they fixed rates at the time? Were they floating rates?
Fixed rate deals. Floating rate really wasn't a thing at that point.
Do you remember generally what the rates were?
I want to say they were around mid 5s. Okay. Probably where they were. Most of these deals were still in the interest-only period. But the question on the table was, hey, is there enough equity above the debt to structure these where it would make sense to take them over? Because at the end of the day, the special servicer would love to, and I think that's what happened in the majority of the deals. The special servicer took those deals back, and then they asset managed them, and then ended up selling them and created value for themselves.
To recoup, sure. Got it.
And so we were trying to step into this situation, and really we had to get the general partner on board. And then once we did that, we had to get the majority limited partners on board. And then once we got with them, we had to go to all the limited partners, have a meeting with them. And I remember we flew down to Florida at this old country club, and it's everything you would think.
So there's one general partner how many majority LPs were there ballpark on these 9 assets?
There's probably, I would say, maybe 2 or 3 gatekeepers.
Okay.
With this, that had a lot of equity in these deals.
So he had probably some JV equity from those guys, or a larger syndication check writer.
They were just the larger limited partners. There was a handful of guys who maybe wrote $25,000 to $150,000.
So that was the next question. So all the other limited partners was when you were at this country club in Florida. Got
Correct.
It. Continue.
And we had to sit down with them and say, hey guys, we've gone through your whole portfolio. We think these are the 9 assets that still have some equity left in them. And here's a plan we think that would work for you guys to get some of your money back, and for you to avoid being foreclosed upon by the lender.
Oh man, this sounds like what we are either stepping into right now or what's coming our way today here in 2023. So I would say, okay, so that's your analysis. Just to summarize it, y'all's goal as the potential acquisition was to just step in as, we'll just call it the new owner, but we're really the asset manager.
Correct.
To the partnership.
Yes. So what we
and take over the financing current in place.
Correct.
At essentially the basis of the debt.
Correct. So the way we went about having to structure this was we had to create a plan where which we could go to the court and say, we're going to file a Chapter 11 bankruptcy. Chapter 7 is where you do a sale. Chapter 11 is a reorganization of the partnership. So we had to get everybody on board on the equity side to say, okay, how do we go about this and get everybody to say, yes, we're in favor of doing this, and then present that plan to the court. So interestingly, the general partner was based in New Orleans. So the filing was in New Orleans, where we went and had to do this. The way we went about it with the original limited partners is we had to reset their basis in the deal. So we adjusted their basis of their equity to where we thought market value was today. And we promised them, we created a different waterfall structure whereby first the new capital that we injected would get paid back, plus a preferred return. Then the original limited partners would get paid back their interest plus a preferred return. Then it would go to a disposition type fee if we were able to achieve the waterfall to that point. And then after that, it would go 75-25 to the original limited partners. So if we were able to successfully execute on our plan, the original limited partners likely aren't getting all of their money back, but there's still a potential that they're going to get a large portion of their dollars back over the time frame, or they could walk away from it and be done.
Now you're saying getting dollars back in y'all's structure, which sounds very fair for the type of deal that it was, and maybe the distress that was there. You're talking about their principal or principal plus profit.
So again, when I talk about getting the dollars back, that's probably on their original principal. I think some of those deals eventually returned more than their original principal back, but some of them did not.
Got it.
So we had to reset that basis to where new market value was, and then their preferred return was based off that new basis, if that makes sense.
It does.
And then the general partner was able to get a certain portion back as well.
So you guys potentially were acting as, in maybe their eyes, kind of a savior to say, listen, here's the plan, which it sounds like y'all put a very detailed plan together. This was a lot of work and effort to meet with them and say, what have you got to lose, right? Essentially your money, or maybe nothing, just time, right?
We'll help you preserve your equity.
Exactly.
We're going to come in, provide fresh capital to come into these deals because they were not cash flowing at that point. They weren't covering debt service. So we were going to come in with fresh capital, allow it to get through that season, lease the deals back up, and create a scenario where some of your equity might be saved. We're creating a path for you. Now, the flip side of this was you had the special servicers on the lending side. They had zero interest in this plan. They said, no, we would rather take these properties back because we see value for ourselves and we like our basis. And I think the highest basis on the debt side was our San Antonio deal at $77,000 a door was the highest debt basis. And that was on 2003 vintage.
Wow.
So that's
I would
where
take that today, all day, every day.
Absolutely. Absolutely. So I think that's where the lender was coming at it from. So then we had to go to court and present our plan to the bankruptcy judge. And then you had all these New York lawyers come down. And I think we had 7 different special servicers we were dealing with in the course of this. 2 of them were fairly appreciative of how we approached it. And
so so let's unpack this a little bit. So from a special servicing perspective, these were 9 different loans,
Correct.
but they had like maybe 1 or 2 had the same originator. Yeah. And so then got it. So you were having to deal with basically 9 different lenders.
Having to deal with quite a few different lenders.
Yep.
All of this was going on in the bankruptcy court in New Orleans. The good news was we hired a really good bankruptcy lawyer based in New Orleans, whose wife happened to be best friends with the judge. So that was a big piece of this that I think helped.
Sure.
The flip side of that is all of the special servicers flew all their big powered New York attorneys down to New Orleans. And
we all know how that goes. Yeah.
You can just imagine the interaction that was taking place.
Sure.
So ultimately, as we move through that process, the lenders, the special servicers are saying, hey, no, we don't think this is a fair plan. And for the majority of them, I think there were a couple that were on board. And the remainder, our side, were saying, hey, look, we're helping the limited partners get some money back, and we're creating a plan where the lender is going to be made whole. We never adjusted the balance of the loan, and we, in fact, were willing to pay back some deferred interest that had.
So I was going to ask, as you guys have analyzed it, we're kind of, what you're talking now is kind of the structure of the financing side and the capital stack. As you guys were analyzing this, what percentage of y'all's fresh capital to the table was going to be, carry costs? It sounds like there was interest that hadn't been paid. It was in arrears, right? So so walk us through that. We've moved to financing now. So, you're structuring it, keep going. Yeah.
So on the financing side, you had the original CMBS loans. We maintained the interest rate and the balance on those. In conjunction, you had some interest that had not been paid, some deferred interest. So that had to be brought to the table to go about this deal. The other was the carried interest, the operating carry that would need to be going forward, because frankly, a lot of these deals, when fires were going on all over the place, just had fallen into the 50, 60, 70% occupancy range. Man. And that's why they were not covering debt service.
Sure.
And then you had to spend certain dollars to bring those units back online that had gone down. And so there was a capital that was needed to accomplish that.
So, you've said fires, maybe not physical fires, right?
Correct.
What were some of the issues that were?
Yeah, I think what ended up happening with this particular partnership was they had run out of funds and had so many properties that, frankly, they just couldn't keep their head around everything that was going on.
Sure.
That purchase orders weren't getting approved. So vendors weren't getting out to the site. Units weren't getting turned. Then they'd go down on units. And then management companies necessarily weren't getting their paychecks on time. Their payroll wasn't getting planted on time. So ultimately, people weren't in the office. And so it's really hard to lease units.
Yeah, when you stop paying vendors, they stop coming. And then, you have... maybe there's a plumbing issue and nobody's going to come out because you haven't paid them for the previous.
And it just cascades on itself. And then until ultimately there's no staff on the property because they haven't been paid. And you can't lease units when that happens. And so you're in a deteriorating situation.
That's tough, dude. What a nightmare.
So ultimately, Kevin, with this structure, we were able to go in, keep the CMBS lenders whole, pay them some deferred interest, not the default interest, but some deferred interest. And then come back in with this structure that we discussed, whereby the original limited partners were able to get some money back if we achieve certain thresholds. All that being said, we were able to execute. The judge was accommodating. He approved our plan. And this all happened at the end of 2007, beginning of 2008. And so one of my first days on the job, I'm going and walking all 2,000 of these units to do unit walks upon acquisition.
Dude, that sounds like my heaven, dude. Just being on property, tons of properties, looking at, all different issues. And these are A's. That's what I mean.
Beautiful properties.
Your first couple of days, you're in really nice areas.
I'll never forget walking some of these deals, because I've seen mold before, but I don't know if I've ever seen rainbow mold like this. I mean, it was like red, green, blue, all at the same time on some of these walls, because like we said, we had some issues.
Couldn't tell if that was an amenity, like
you couldn't. It was
an accent wall or something like that.
Yes. And then I remember walking a unit where I believe it was a lady who had not paid rent for quite a while, and I'm assuming she must have been an alcoholic, because it was covered wall to wall with wine bottles on the floor across the way. I'm like, how does somebody live like this?
Sure.
But ultimately, there was a lot of work to be done on these properties. And so we had to go in every unit, take inventory of what was needed to be done on each unit, And that was back before you were really using tablets to do all that stuff. So
Mhm.
I'm handwriting all this stuff. Then I'm having to go back
The clipboard and
clipboard.
I've been there.
Go back to my computer and sit and type in, well, okay, what does this one need? New flooring? Does this one need new paint? Does this one need new countertops? Is it missing cabinet fronts? Does it need new appliances? And just going down the list
Sure.
on every single unit.
So from the day you got the call on the potential acquisition to, the day that maybe you guys closed, or let's just back up a little, like when finally the courts said, we like this plan and it was approved. So then y'all closed. What was that time frame?
I mean, it was like pregnancy, man. It was like 9 months. And
I don't know anything about that.
And it increased in intensity and frequency as those pains came closer towards the end. But yeah, it's about a 9-month process ultimately. And I'll refresh, it was back in the end of 2007, beginning of 2008, when all this went down. That is just before, mind you, the GFC and the great financial crisis. So that's just the first part to this whole story. So once you buy these things, then you got to go asset manage them. And so we're spending dollars, we're turning units, we're leasing units, we're getting everything geared up to go. And then the market crashes.
Okay. So you guys ultimately, the court system thought this was a good idea, approved everything. Then, in a short period after you guys closed, you had your capital structure in place. You had all the investors on board. You brought your capital to the table. Now, through your analysis, obviously, you thought there was operational upside,
for sure,
adding value somehow. So, the E of the safe is the exit, right? I say, well, you got to begin with it really should be E first, because if you don't know your exit, why even start running the process? So tell us what y'all's business plan was, what you initially thought the exit strategy would be, how that changed given the GFC, and just run us through that.
So
time frame.
Maybe you need to change your E or put a slash there and say execution and then exit, because you got to execute before you can exit.
Correct.
And that was part of the issue. So we got everything geared up. We're spending dollars, we're turning units, got everybody in place. We fixing a lot of the problems that were going on at these properties. And then the great financial crisis happens. Then the bottom falls out from the market. Then occupancies tank, rents tank across the board in all of these markets. And everything that the plan we had laid out for the bankruptcy court, nothing was going to plan. It was a very difficult situation.
Man.
So you can imagine we're feeling great about this opportunity. Our basis is good. We're able to execute. We're making headway, and then the bottom falls out. So we had a choice at that moment. On a lot of these deals, the liquidity had dried up for us. And so we were in a tough spot. We're almost back to the same spot where we started with the lender. And some of these lenders, basically none of the lenders were willing to work with us at that point. They just said, hey, we would love to take these deals back. We're special servicers. That's what we get paid to do. So we're not even going to talk to you until you default on these loans. And I think a lot of people are in a similar situation today. They can't get the lenders to talk to them until they actually default on the loans. Well, once you default on the loans, then it starts a process, and it's really hard to get out of that process once you start it. So it's the chicken and the egg a little bit.
Sure.
You want to go talk to the lender, say, hey, we need to restructure this to figure out a path forward. And they say, hey, we're not talking to you until you default. And so we were in a pickle.
Sure.
And we had to figure out a path forward.
I would say one thing you're mentioning that is very important, that I would say I learned many years ago is just communication. And we've mentioned that on another show, is just start communicating up front with the lender. Hey, we're having issues. Are you guys willing to work with us if we get into a situation, and let them kind of tell you what's going on.
100%.
Right? And today I see, guys that they call their lender and the lender says no, and they just like, oh, well, lender's not going to work with me, instead of staying after them and sharing what's going on and over communicating, right? Your lender's your biggest partner, right? That's They're your debt partner. Why would you not be communicating with them? Why would you not be talking to them? So I'd say internally at our shop, that's something that we have always tried to over communicate, just on an asset manager perspective, with everybody, investors, lenders. So
makes a ton of sense.
Yeah. And that's what you're talking about. So I just wanted to make sure we highlighted that.
Yeah. And just to be plain, I think some lenders are easier to talk to than others.
Yeah, for sure.
And in particular, CMBS special servicers are one of the most difficult, because they have a fiduciary responsibility to the master, who has a fiduciary responsibility to all the investors in those deals.
And they're transactional, right? There's not a necessary relationship there.
That's right. So if you have a bank loan or a bridge type loan, or maybe even an agency loan, you might be able to make more headway from that perspective. But that was a very difficult proposition. And ultimately we had to go back to our limited partners and figure out a structure whereby we might be able to fund some of the shortfalls given the financial crisis.
So you guys got in as, the knife was falling. You were trying to catch it, and it ended up cutting you.
We got cut.
But, you obviously didn't see, the GFC coming. As the last 12 months, none of us saw, an unprecedented rate hike coming, right? So I think that's just, one of those things that's out of your control. Tell us how you guys overcame it.
Yeah, very difficult proposition to go back to partners and have to ask for more money. That's just tough. And ultimately I look back and we were able to create a vehicle whereby new capital was able to be injected into a number of these deals. And that really solved the situation. However, there were 3 deals in particular that were very, very difficult. 2 of them we ended up having to sell right in the middle of 2010 to create some liquidity for us. So that would help fund the remainder. One, ultimately, the one in Houston, I think ended up having to go back to the special servicer. So we did end up losing one through that scenario. However, the other 2, we were able to sell and create some liquidity, which helped on the other 6 properties. Now, I look back, what's crazy about this, Kevin, is when we look back and we look at the numbers, a couple $100,000 would have created probably $10 million of value in these deals. Just
on like from an NOI perspective, or how so?
If you were able to float just a few more months of funding on these deals and not have to sell them and not have to hand them back, if we were able to float through that period, the market rebounded.
It started picking up, rents and occupancies,
and just a couple $100,000 on these deals would have created millions of dollars of value. And so that's probably a good thing to think through as people are going through similar situations. Is it's cost benefit analysis. It's really hard to go back and ask partners for dollars, but will those incremental dollars create that much more value in the end?
Sure.
And that's something.
And I think that you're exactly right. And you have to have that forward projection, and it's got to be a really detailed analysis to understand what's the least amount that we need to float through to, save the deal, I guess, is kind of what we're talking about. Right.
But you look back, it was a really scary time. And then that's 2009.
Well, that's what I was going to say about y'all's situation is you were not the only ones in that situation. Obviously you had a very good opportunity for all intents and purposes. You thought, hey, we can, given our track record, we can take care of this. And then a macro event affected you guys.
That's right.
And you're not by any stretch the only guys that were, special services were taking back deals.
No.
And you did everything that y'all could to try to make them work, save them if you want. Whatever the word is, right? So, okay. So after those 3, bumpy ones, how'd the other ones go?
The execution piece, right, was a struggle. So that's how those 3 exited. And then I look back on the remainder, and man, those were held until probably 2014 through maybe 2013 to through 2016.
Really? Okay.
Those time frame.
So 8-10 years, somewhere in there.
Correct,
yeah, got it.
Correct. And I would say all of those ended up returning a majority of those original limited partners their dollars back from their original investment.
That's great.
Which is amazing to think about. And going through that season of time where they had an operator who just got in over their head, and then you had the great financial crisis happen in the middle of that, to be able to walk away and still get the majority of their dollars back in the deal.
So what do you think was the average time frame that these investors were in their deals?
Yeah, I would say most of those guys were probably in it for at least 10 years.
Interesting.
10 years.
Man. So exited the deals, like you said, 2014, 2016-ish. This is, we'll summarize, but anything else to add on just this whole specific deal scenario?
Yeah, it was a really interesting deal. Probably the most interesting portfolio I've ever worked on in my career. It was a lot of energy spent, a lot of headspace. It was a lot of opportunity, but it was also just challenging. That season was challenging. I think we're probably in a similar season in the world right now. There's probably a lot of challenges that are coming up for guys. And really, it came down to execution. Could we execute on the plan that we had in place? I think if we would have known the great financial crisis was coming, the plan might have been a little different, frankly. Nobody saw that coming, and how that would affect the markets and occupancy and rents and everything that went on with that. But really it came down to execution. And I would say, I think you can't control what the capital markets do ultimately. But as an owner operator, you can control how you asset manage your deals and you property manage your deals, and you spend dollars on deals and think through all these things, because you have a fiduciary responsibility to your investors to maximize value. So how do you best go about that? How do you think through that? I think ultimately that was the lesson I learned walking away from this is I not only had a fiduciary to the original limited partners, I had a fiduciary to the special limited partners that came in on top of that, and had to create value for them for the proposition of coming into these deals. And how do we not only preserve their capital, but grow it?
Sure.
And that was our responsibility to do that in that season. It was very difficult. There could have been times where we just said, hey, throw my hands up, I don't know what to do, and walk away. And a lot of people did, frankly. But ultimately, we put our head down, worked really hard. And I think at the end of the day, everybody would say that was a great deal.
Love that. It sounds like just the deal story itself is great. So there's a couple of lessons here. I would say the first is this business is not easy.
No.
Even when times are good, right? It's very intense. There's a lot of moving parts. And if it was easy, everybody would do it, right? We say that a lot. That's so again, I think that, with syndications, where's the motivation from the general partner? Are they thinking of themselves first, or are they thinking of who they have the responsibility to? You were talking about, labor earlier. It's all like marriage, right? Like you come last.
That's right.
So I think that, what you're saying about understanding and learning that you have a fiduciary responsibility to investors, the lender, everybody involved. It means, hey, I've got to go to work no matter how hard this is, no matter how tough the market is. I still have to show up because I promised these guys that I was going to do my job, and they're relying on me, right? And so we hear this a lot in our business. Just do what you say you're going to do. Yeah. And if you hear that, then you're doing all right. We have a partner who doesn't say anything. He's very he's not friendly, just it's not his personality to, and he said, well, you guys did what you said you were going to do. And when we got off the phone with him, we were all high-five. We're like, that's the greatest compliment we've ever gotten from him because he's quiet, right? So, okay, so let's summarize, right? So sourced it, had a great relationship with a local broker that knew you guys were good operators and can execute. You pulled all these 55 properties together, obviously took time. You singled out 9 assets you thought would work, and then came up with a plan. So through that plan, had to go to the special servicers, obviously the general partner, and then the limited partners and all the limited partners, right? So the financing piece is you're trying to just assume their current debt, but also even equity, right? Like restructure the capital stack and bring in fresh equity. So you're out raising more from new partners, right? Correct. Ultimately, it all got approved. The financing was approved legally. You guys closed. As you say, now it's time to execute. Great financial crisis hits, completely out of y'all's control. You're doing everything you can to asset manage effectively. Like we said, do what you say you were going to do. Yep. And then ultimately through that process, 6 of the 9 ended up being very, very successful.
Correct.
So I would say
even the 2 that we sold,
you sold them. Yeah.
It ended up creating value there that wasn't there.
So 8 of the 9 ended up being, successful. I think that, dude, this is the purpose of this podcast. It's just a deal. That's a deal talk. Like, I mean, when else could we hear or anyone else hear about something like this unless you were at Trivest or on that brokerage team, maybe one of the investors. So we're talking, between maybe 22. I mean, I don't know how many investors were. Let's just say 100 people know this deal story. Dude, this is awesome. And I think the other lesson, which I wanted to save till after is, we call it the safe method, but just because it's that, like, no investment is ever safe, right? It's really a framework to make sure that you're doing your homework every step of the process to ensure that you can do what you say you're going to do. Right. When the market shifts on you, there's only so much of that you can factor in. And that's what you and I are talking about today. I mean, even on deals you and I are actively working on, it's, that's the big question mark is, hey, are we headed for another GFC? Where are things going? So
nobody knows. But what I do know, and what I learned through this whole episode, was that relationships matter. It was the relationship that we had with the broker. It was the relationship the broker had with the general partner. It was the relationship the general partner had with those limiteds. It was the relationship that we were able to cultivate with our lawyer and the judge. It was the relationship that we had with our property management, our asset management, our
Mm-hmm.
regional managers on the site, our maintenance guys on the site every day. It's the relationships that they were able to accumulate with the residents on the properties to help
Mm-hmm.
renewals happen, to help new move-ins happen, to create community. All of these things were dependent upon relationships.
Mm-hmm.
And so I think at the end of the day, what I learned is it's really important how you treat people because relationships matter.
You're exactly right. This is a people business. And back to what we talked about with fiduciary duties, like you're last and you got to take care of everybody else first. And, I'd say you're a seasoned veteran in our industry, right? The others that we've had on the show, very much talk about relationships. And I think it takes years and years in this business to really understand that that's very, very important. So
For sure.
I appreciate you mentioning that. So,
Well,
dude,
appreciate our
that's
relationship.
100%.
Yeah.
So, well, listen, dude, that's as far as deal talks go, this is one for the books for sure. So, well, let's move to just a couple questions
All right,
and
what
then
you got?
something fun. So I appreciate that story very much. So, all right, first question. What's one thing you would change about the multifamily business or industry if you could?
Oof, what's one thing I could change about the multifamily business or industry if I could? I would just say I think we were talking about this a little bit before, but effectively each property is a multi-million-dollar corporation. And the structure of our industry is the CEO of that little corporation is typically a middle-aged woman making not that great of a salary that's in charge of running that whole multi-million-dollar
Mhm.
corporation. I think there's got to be a way or a mechanism whereby we could create an avenue for very talented, maybe younger folks or a different avenue for the management platform
Mhm.
to just have a different feel about it. I mean, I think some of the managers I've met are fantastic. They're
Agreed.
great ladies, they're great men that do it and are really good at what they do. And I wouldn't change that. But I think there's also needs to be an avenue to create more of a broader swath of people that could fill that role in our
Mhm.
industry. I think that would be a huge help.
Like you said, I've talked about it. I think that's I've talked about this several times over the years, right? And another guest we had mentioned management. It's how do we, for this question, they would change management somehow. And I think with him and you and I, if we can forward think on that kind of stuff, I think we can do this kind of stuff. So, but yeah, I think you're right. So good answer. How about that? Okay. So second question, what advice would you give anyone in the business or trying to get into the business?
Yeah, I think giving advice, it's real simple. It's just treat people really well. It's all about relationships,
Sure.
and in relationships, it's thinking of others before you think of yourself. I think you mentioned that earlier, Kevin.
Mhm.
That's who I would say for anybody looking to get into the business or want to maintain a presence in the business is hopefully just learn that relationships really do matter and live that out. So.
It's great. It's great. All right. Last question. Where do you see multifamily heading in the next 1 to 3 years and then the next 5 to 10 years?
Great question.
Get your crystal ball out.
Man. Yeah. Because, everybody's right on their crystal balls.
Correct.
1 to 3 years.
You said you've been here, 15 years ago, so you know what's going to happen.
That's right. That's right. I think 1 to 3 years, we're going to have some headwinds against us right now. I think originally it's been the interest rates that have increased. I think conversely, because interest rates have increased, equity has become harder to come by for guys doing deals just because, hey, why go
Yes, it has.
jump in your deal when you're promising me a 6% cash on cash when I can go park it in the bank and earn 5.5 with no risk associated with it. So I think in the short term that's been an issue. I think also there's been the headwinds of insurance and property taxes. I mean, both of those expense line items have just exploded on us. I think on the insurance side, it's because there's just been quite a decade of losses for the industry and not a lot of profit. And so, the market's readjusting accordingly. I think on the property tax side, supposedly the governor's trying to help on that front. And I don't know how much that's going to help on the business side of the equation.
Texas, right?
In Texas. Yep. Yeah. So that's been a huge headwind. And in concert with that, the rents haven't appreciated as much to offset those things. And so you've got a scenario whereby the cost of capital has increased, your debt service has increased, and your NOI is effectively flat or falling. because your
Expenses.
income, your income hasn't kept up with your expenses. So that's just a recipe for value decretion in the marketplace, and we've seen that. And that's the headwinds, I think, the next 1 to 3 years. There's a lot of loans coming due that were put on in the end of 2020, beginning of 2021, throughout 2021, that were 3-year terms. And they have certain tests, that service coverage tests that they have to meet.
Don't remind me, I have a few.
I think these are going to come to a head. I think a lot of investors have gone out to their partners and tried some capital calls to see if they could figure out a scenario whereby they might be able to float these deals. And some of those deals they're going to have to be sold. And if you can get them out of the loan, they feel great about it. I just think there's going to be a reset in the marketplace from that perspective. So that's what I think is going to be the issue in the near term. I think once we get through that and the market kind of resets expectation on pricing and deal volume and all that, then I think there'll be quite a bit of opportunity, frankly, for folks like yourself and others to jump in. And I think the operators will really separate themselves in these scenarios, the guys who are able to execute. The next, beyond that, who knows? But ultimately, I wouldn't be surprised if somebody somewhere somehow figures out how to build Class A multifamily at a much lower basis. I don't know if that's through materials are materials, but maybe through the removal of labor to some degree. I don't know if robots or mechanized building is going to take that over. I know guys have thrown out the idea of using shipping containers to build homes. Somehow, some way, somebody's going to figure out
3D printing apartment communities.
Somehow, some way, somebody's going to figure out how to build at a basis that would make sense and be competitive in the marketplace. No one's done it yet.
At scale, of course.
At scale, obviously, yeah. To be able to do that across the board. And if you can imagine, if somebody is able to figure out how to build a Class A apartment at $120 a door, what that does to valuations across the board. So, look, I don't have a crystal ball. I don't know who that is. I don't know what that is. I don't know how that is. I would imagine if somebody's smart enough to have figured it out, they would have already figured it out, but it's not here. But maybe at some point, somebody figures out a solution to the housing issues that we have.
So short term, a little bearish, just tough out there right now. Long term, definitely bullish. Can be a lot of opportunity, but you see that potentially through innovation.
Yes. On the short term, what I would say is there's a lot of headwinds. If you are needing to sell, I would do it sooner than later. I wouldn't wait around because I think there's going to be a lot more product that's going to have to be on the market, frankly. And a lot of us brokers are talking about maybe post Labor Day, a type situation where there's a lot of product that hits the market. So if that's the case and you're a seller, I'd say, hey, don't wait around. Let's go. Conversely, if you don't have to sell, I just wait. I mean, unless there's a reason that you need liquidity at this point, and the market's forcing your hand because you had a low maturity or your equity partners say we need out, I would say, hey, just hold on. At the end of the day, I've only seen two types of people lose money in real estate. It's people that had to buy something and the people that had to sell something. Everybody else seems to do just fine. It's really hard to time the market. But if you hold on over the long term, appreciation happens and you should be good.
Sure. Well, I would say I agree on all fronts on that question for sure. The market's tough. And while I love a good deal story, this deal story reminded me that the market's tough. So how about we turn that front upside down and do something fun?
That's right.
So this is my segment I like to call buy or sell. 10 just rapid fire, quick, scenarios, words. And buy is you like it. Sell is you don't like it. And, you can elaborate as well. So first one on deck. Here we go. Buy or sell. A Chipotle burrito.
Oh, buy all day, baby. Good stuff right there.
All right. Next, bridge debt.
Ooh, actually, it's probably a good time to use bridge debt because if interest rates do fall in the future, it might be good. But frankly, from a risk profile, if it was me, I'd sell. I wouldn't want to take that risk profile on.
Selling bridge debt. Okay. Next, playing offense.
Buy all day. You don't want to sit back and be defensive at this point. I think this is the time to, like Warren Buffett says, be greedy when others are fearful and fearful when others are greedy.
I agree. So I would say my buy or sell and playing offense is, the last 5 years have been really good for everyone. And now the last 12 has been very tough. And it's back to fundamental real estate, making calls, being in front of people, blocking and tackling the relationships. And I think that's how you and I, cut our teeth in a tough market. And it was definitely a shock for, 2 to 3 to 4 weeks for me. But I was like, oh, I've done this before, and just started playing offense. So I have a sign on my office that says play offense every day. So I'm buying offense with you.
Absolutely.
All right. So this one's for the time right now. Wimbledon.
Wow. Love Wimbledon, man. It's fun. Buy all day. It's fun watching. My wife is a tennis player. So
awesome.
She can crush me in tennis.
What about soccer?
No comment.
Okay. Next, buy or sell a Colorado fishing trip.
Oh, buy all day, man. You can't go wrong in Colorado, and you can't go wrong fishing. So those two things together, fun.
And whether or not your phone does work, you tell people you were out of service.
That's
so
right. That's right.
Okay. Next, and I've actually asked every guest this for the times: work from home.
So this is probably a neutral. I don't know if you have a neutral option. I think our economy has learned a few things with work from home. Number one, that you can still be efficient and work from home. But number two, there is something lost when you work from home. So I think it's a little bit of both. I think there's probably a hybrid type answer to that the world has shifted. I think there's probably going to be some function of work from home that's going to stay with us.
Mm-hmm.
I think there's also a large portion that's going to be a return to office. There's some jobs that you can only do from an office, and there's some jobs that frankly you can do great just working from home. So I think the answer is probably somewhere in the middle for the majority of the employment base, and that will allow folks to execute. Look, at the end of the day, if you're not productive, it's not going to work. So you have to be productive. And I think for the folks who figured it out and can work from home and be productive, that's great. And more power to you. Flip side of that is, just because you're in an office doesn't mean you're productive. So you got to be productive when you're in an office too. I mean, I've seen a lot of guys just like sitting around the water cooler, not really working. So that doesn't solve it. But being at home doesn't solve that either. So at the end of the day, I think it boils down to what is your work ethic and how are you going to go be productive in the workplace, regardless of where you work.
So we're buying or selling.
I mean, I think over the long term, it's a buy.
It's okay.
To some degree. I wouldn't sell it. I think there has been some productivity loss with it as a result of COVID. The flip side, I think we learned that we can do a lot of things from home I'd
say at least in our business, as we discussed, it's very relational. Right. That's hard to do from, from Zoom, 100%. Yeah. So, okay. Next one, buy or sell, interest rates dropping in the next 6 months.
So interest rates dropping in the next 6 months would have to be a function of inflation falling. And my concern is that if inflation's falling, it's likely because the economy slowed down. And the question on the table would be, has it slowed down enough to a point where we're in a technical recession and the Fed is cutting rates to try to stimulate the economy? So all that being said, I think it's a likely scenario that rates will remain steady, if not fall at some point.
So I contemplated,
I
contemplated putting 12 months on here. So what about 12 months?
Yeah, 12 months is probably more of a correct, they will fall. I mean, but you look at the futures curve, the only thing the futures curve tells us is that they don't know the future.
Yeah, correct.
Because you look at it and it's like, it's always wrong, but that's how the market sentiment is at the time. And that's what people are anticipating.
Sure.
I think it would have to be a function of an economy that's falling. You look at it from a political perspective, it's really interesting. We're coming up on 2024 election cycle. Fed doesn't like to appear political. So will they hesitate on doing anything with rates as it comes up on that cycle? Maybe. Will they cut in the midst of that? Maybe. I don't know. I think it would have to have inflation come down materially, which it did. This last print was 3%. So, the anticipation is that continues to fall. That might give them the room to at least pause, if not start cutting. And if that's the case, then rates would ultimately fall.
Sure.
But the flip side of that is employment's still strong. And if the employment's strong, the Fed follows.
They're not happy.
Curve,
yeah.
And so they think there's an inverse relationship. And I think there is to a large degree of unemployment and interest rates. But at the end of the day, it's really hard to say, man. Really
so 6 months, sell, 12 months, buy.
There you go.
Without holding you to it, right?
There you go. Yes.
Okay. Next one, U.S. women's soccer.
Yeah, so I've got a daughter that plays soccer now, so I'll speak highly of the women's soccer team. They're going to get a three-peat here in the Women's World Cup. Excited for her to watch them. As a guy playing, I'm excited for the women. I'll just say that.
Perfect answer.
There you go.
Put that one in there for you. So.
Yes, thank you.
All right. Also, in the last day or two, buying or selling the new Mission Impossible, or do you like the Mission Impossible series? Maybe whatever. So
I do like the new Mission Impossible series. I've heard that it's a 2.5-hour ordeal. So I haven't actually, with 4 kids, it's really hard to get out for that amount of time. But I would love to watch it.
Yeah. Well, maybe I can help you figure that out. So, all right, last one, and this one actually is for you: adoption.
Adoption, man, I love adoption. So, our number 3 in our family is a little boy named MJ. MJ, we got to adopt in Texas secondary market known as Longview, one of our favorite markets.
Yep.
MJ is just a joy to our lives. It's really fun. He clearly doesn't look like us, which is really neat to just have him be part of our family. We love him. He's amazing. We think adoption's amazing. It was really a gift for us to be able to do that with him. And man, here's the reality. Adoption only exists because brokenness does. If there's something wrong. If there was not something wrong, then adoption wouldn't exist. And because our world is just, stuff happens and people get in tough spots. That's why adoption exists. And we raised our hand and said we'd love to do that. And we got fortunate for his birth mom to have chosen us, and got to meet him, 3 years ago now. And he's been part of our family ever since. And he is a ton of fun. He's the only boy. So I had to go outside the gene pool, get some testosterone in our family. So that's fun. And he's a lot of fun. It's so much fun having a boy. And we have yet to cut his hair.
Awesome.
How about that?
Yep. So buying adoption.
Oh, all day long.
All day.
All day.
Yep.
It's, if you're on the fence on something like that, look, I think it's a calling. I think you got to say, hey, I'm supposed to do this. But man, if you feel like you're supposed to do it, go do it, because it's amazing. It's such a gift. It's really been more of a gift to us than I think anyone else. Just our family getting to add that dynamic and him in it. He's such a blessing. So
that's great.
All day long. Yes. Bye.
Dude, that's buy or sell. And wrapping up deal talk. What a fantastic deal to bring to talk about. I think it's, very timely for what we have going on in the market. And man, even just your analysis of the whole thing, having been through it 10 years ago, to look back and relate it to today, and then just your answers to these questions were so thoughtful. And it sounds like you definitely have spent a lot of time trying to understand your position, your role in the business. And man, I just appreciate that. So, and appreciate you being here. So,
likewise, Kevin, you're doing an awesome job.
I appreciate it, man. Last way, how can somebody get a hold of you?
If you want to get a hold of me, real easy. Go to Newmark's website, search for Matt Wideman. Email is matt.wideman, Wideman, just like it sounds, Wideman, at nmrk.com, or you can call me at 214-704-8240.
Perfect.
There you go.
That's wraps up another episode of Multifamily Deal Talk. Matt, sincerely appreciate you being here.
Likewise, Kevin.
Thanks, man.
Fun.
Yeah. Have a good one.
Peace.